Oh, you don't drink at all?
I don't. I don't. I
Okay.
have serious control issues.
That should have been the first question. We might not have even done the podcast.
Right. Welcome to the Future's Edge podcast. We have Anne-Marie Band, who is trader, chief market strategist at tradingbook.com, and someone who I've been following on Twitter and reading what she's been writing for years and never actually spoke to her. As always, we also have Bob Iacchino, who's the brains behind the operation, the executive producer and co-host of the show. But Anne-Marie, welcome, and thank you for coming.
Thank you. I'm so happy to be here.
So let's get down to serious stuff right away. Dogs or cats?
Both if I weren't deathly allergic to anything with fur or hair.
Okay, moving right along.
I'm not allergic to humans. Yeah. I love animals.
What was the last 2 years? What was the best TV show or the best movie that you saw?
Best TV show. Maybe it finished more than a couple years ago, but it was Breaking Bad.
Oh, Breaking Bad was outstanding.
The series. Yeah.
No
Just
doubt about it.
Incredible character development.
No doubt. Some of it was like troubling. Like there was times where I turned off a scene because it affected me badly and didn't come back to it for
That's
like 2 months.
Yeah,
particularly. Yeah, exactly. There's one I was almost ready to describe, but I will not. Yeah. Did either of you guys watch Stranger Things?
No, I watched one season of it. Didn't love it.
Yeah.
Anne-Marie, did you see the final episode of this season or no?
I have not. I could not get into this last season at all. And so one of the kids said, "Got to watch Stranger Seasons. You got to watch Strangers." And finally I did. I watched the first couple, but I don't know what made me lose the vibe to hang out in there. I don't know.
Yeah, well, this last season, because I watch it with my daughters too, and nothing gets resolved. They have a whole season, and every storyline they started, nothing gets resolved at all. They didn't kill the bad guy.
Terrible.
So I'm done with it. It was manipulative. So I'm done with Stranger Things. What about movie? Before we move on, then.
Wow.
Did you see Coda, by the way?
I did. I loved it. It was fantastic.
Yeah, I loved it too. Yeah, I thought it was a great movie.
Yeah.
I thought it was very moving.
Yeah, it really was. It was fantastic.
And I
loved seeing Marlee
nobody's seen
Matlin.
it. Yeah, me too. Yeah,
I loved seeing her. I'm a big fan of hers, and
my buddy dated her at junior college in Palatine, where the town I grew up in. She's from where's she from? Like Park Ridge or somewhere in the northwest suburbs.
And if we're talking about those kind of stories, I dated. I asked Cindy Crawford on a date.
Did you? And what she said?
She said yes or no.
Oh, she said no. That's a funny story. Happy to go into it if you want. But when she said no, I'm like, I don't care. I just
was nervous.
But I asked you on a date.
Her mistake. Her mistake, Bob. Okay, so today we record on Friday afternoon. Today we saw the retail sales number, which was higher than expected, which surprised people, including myself. I've been of the belief that we are either in or going into a recession relatively soon. I believe in that Atlanta Fed GDP now number. The question is, am I wrong? Because I'm starting to think there's a greater chance of me being wrong than normal. Anne-Marie, thoughts?
I definitely don't think you're wrong. The question might really have been, yes, retail sales are up. How are they funding those? Because credit card debt is also up. And so that doesn't particularly bode well, but it's the adage, when people feel bad about things, they're gonna shop in this culture, right? If we feel bad about how things are going at work, we're gonna go try and buy the most expensive beer that we can buy so that we feel, hey, at least something good's going on with me. And so that psychology driver could be affecting, why retail sales is up. But again, the engine, you can see credit card debt is up, and real income is not rising because we've got the rate of inflation that's moving at the space that it is. So yeah, it's pretty much a dumpster fire out there, to be honest.
So you mentioned wages. So the last reading of the CPI, we got that monster 9.1, which I think is wildly understated. I think inflation is much higher than that. But wages only increased 4.2% year over year. Is that something that the Fed is like glad about, so they're not getting caught up in this wage price inflation spiral? I know it's not good for the people who can't make ends meet and can't put food on the table right now, but do you think the Fed takes some solace in that number?
When I think about the Fed and its mandate, I think by default they have to look through the paper roll. So they have to go, okay, we're going to focus on inflation. We can't look at too much stuff. And we're already looking at outdated stuff that a lot of people argue with us as being valid or not. And we just have to focus on one thing. And here, I'm not trying to throw shade, but the fact of the matter is that the people that are running our monetary policy haven't ever really run businesses.
By the way, if you were about to say politically motivated half-wits, we ring the bell and you win, because that's what we try to get our guests to say often. You were almost there, by the way.
Not gonna do it. Not gonna.
Okay.
So gonna try to be a good girl here today.
Yeah.
So I believe that when you spend a lot of time sitting in academic realms, there's a major disconnect between how things really work, how we would like for them to work, and what we can actually do to change the way they work. And so I think that they're sitting in some sort of weird silo that, they're not gonna fix anything. It's just they're going to plod along until something breaks. But I do think that they aren't necessarily, they're going to pull on any string that says, okay, checkbox, that works with what we're thinking. And if it doesn't work with what we're thinking, we're just going to ignore it. And that's what they're doing, in my mind.
Yeah. So today, what was interesting, after the retail sales number, it seemed to me that the door was kicked clear for them to go 100 basis points at the next meeting. Quickly, the market took that away and started zeroing in on 75 basis points. As last I looked at it, the Fed funds curve said 70% chance of 75 basis points. Why? As they saw that number, don't you think they would have paraded somebody out in front of a camera and led us to 100 basis points if they're so singularly focused on inflation, or are they worried?
I think they're all a little worried, whether they say they are or not. That's just what that's going on with. If I were to put my 2 cents in there, I would say, they're trying to not be knee-jerk, like how the market is when it falls off a cliff on Wednesday and then, chatters up into the close today, holding all of these ledges. I don't think they want to be viewed as being led around by data, even though they are, right? There's so much credibility in the wings that's just continually being lost that I think they're just going to say, hey, listen, we're just going to plod along, because 100 basis points would be like a gut punch. So
yeah, no doubt.
So I think that in my mind, my thought is this is just going to give them more comfort that 75 basis points is going to be okay.
Okay, so this is going to be a question for you and for Bobby too, because we were talking about this at the trading desk today. Do you think the Federal Reserve, now we have to be honest here, they do what they can to lead us to what they're going to do, and they have in their head what they think is the right thing, presumably, unless they're politically motivated, but that's a different discussion. It's 2 days before the meeting. They look at the Fed funds futures curve. and the market's saying there's 85% chance of 75, even if they wanted to go 100, do they then say, okay, the market wins this time and we can only go 75? Do you believe that's possible? That's for you first, Anne-Marie.
Oh, me. I was looking at Vigo. What's that? Again, I just think 75 looks good, fellas. Let's do it.
So the Anne-Marie's answer is that they're too dumb to take that into consideration, is the way I'm interpreting that. Bobby, where do you fall on it?
So one of the things that I've noticed is that when the CME Fed Watch tool is above 90%, it's almost spot on, like with what the Fed does. Now, I don't know. What I've been trying to figure out lately, is that just a function of clear communication by the Fed telling the market what they're going to do so the market prices it correctly? Or is it the Fed looking at it and going, hey, they expect this? You know, I think of the same thing with the Atlanta Fed GDP Now tracker, right? Somebody was asking me, actually it was Shelley, was asking me if I thought it was going to be negative when I did a TV spot with him the other day. He was like, you think it's going to be negative now? And I said, well, the GDP Now tracker is kind of like a box score in a baseball game. Like, you know, the inning proceeds, 3 outs, you look up at the box score and you see, oh, was that a double play? Was that an error? Was that a, you know, the GDP Now tracker takes the data that was just released and puts it into its model, spits out a number. I suspect that's more like what the CME Fed Watch tool is. By the way, I look at that thing multiple times a day in markets like this, and at least every day otherwise, to try and get a gauge on where interest rates are priced rather than having to do the math myself. So I think it's more of a function of the Fed communication. The only place I think the Fed communicates correctly is on what they're going to do. And I'm talking about the Jay Powell Fed. I think Yellen was terrible at it. I think Bernanke was the worst we've seen. And who the hell knows what Greenspan was saying?
Yeah. Oh, yeah. He intentionally would say those words. I will put on this, and two things about it, and then we're going to start talking about equities. But I'll say that I've totally forgotten how to actually calculate what the Fed funds curve is telling me, which I used to have to do that before the CME Fed Watch tool. So now I just have that running all the time. But I also think if the three of us were running the Fed, we would know that it says 95% chance of 75, and that would influence us a little bit on game day. But
you think it's
Emery, let's go. Yeah. And so, Emery, let's talk about equities for a second. How far out do you forecast, or when the trades you put on, are they mostly shorter term, medium term? What do you got?
Okay. So I try to change what I'm doing based on how the broad market looks. And I have this super simple thing that I look at. I look at the weekly instruments, right, on the weekly chart, and I will look for the 5 or 6 simple moving average, and I won't look at the close. I'll look at typical price, right? Just tell me where that median sits. And if I start closing underneath that curve, it starts to flatten or it starts to fade, I will start pulling back. Instead of opening new trades, I'm going to be closing what I've had that's long. And so I've been doing a lot of that from the beginning of the year to the point now where I really am sitting with a lot more cash than I even feel is maybe prudent. I don't know, but I get the feeling that we're going to have some kind of 8 sigma event in the near term, and I want to have dry powder.
Okay, so my question is this, and I tweeted about this yesterday, is that I like to think that a corrective period is over when I see a vol spike. And again, I'm going to give Jeff Kilberg credit here, which it's literally physically painful for me to do. But this is a couple of years ago, and I heard him on
fill
TV,
this up again.
And he said, when I see a VIX at 60, I buy. And I thought, you know what? He's right, because that means the panic is here. My point now, though, Anne-Marie, is that we haven't seen a big VIX spike. Is that indicative to you that there's not enough panic and the people haven't thrown in the towel yet?
So a couple of people have been talking about this depressed VIX because I do watch it a lot. And so what I've noticed that is really depressed for as much real volatility as I see in the market space. Just like today, we only have 2 new 52-week lows, but yesterday we had over 100, right? And so, and that's when we close in for things that trade more than 5 million shares a day. So when I go to try to read about, well, why is the VIX so depressed in this kind of environment? And the one thing I notice is relative to a weekly chart, it's still more elevated because it's been running at about 18 if we look at a weekly chart, something like that. But the idea has been floated out that because we have so much systematic buying in the market, oh, it's Friday, you just got your paycheck, here it is, you're going to buy some of the S&P, you're going to whatever of the million ETFs that come out every week, and all of that is making people think that, hey, we still get to buy the dip. And so VIX in the grand weekly space is a little elevated, but likely we get this sigma shock and the VIX will spike out of the blue with no warning, is what the storyboard is. And I'm inclined to believe that because there is a relative amount of complacency. If the ARKK continues to have these bottoming spaces where people come in and they have massive inflows, then people are still thinking, hey, you know what? We're going to come out of this as long as I have a time horizon that's X, and it might be 5 years, it might be 7 years. I have no idea how long that time horizon is. Everything is going to be fine. And there's a real bifurcation of thought out there, because if you sit down and you read a lot of macro guys, they're like, build the bunker, fellas. Just go get all the whiskey you need because there's trouble coming. And there is a sense that we're going to have that. But I think that shock is also going to be V by the time it gets to the bottom of where it's going. So the short answer on that is, one, I would never think to buy the VIX, to buy the market when the VIX shoots to 60, because I do believe that the next time the VIX goes to 60, it's going to go to 120. So so there's that sense. That's why I've got so much uncomfortable cash. And I feel uncomfortable about the amount of cash, but I'm always looking at, well, what's telling me that things are going to go right, that we're going to right the ship? And I'm not getting a sense of that turn being made.
Okay, so the Goldman research came out last week, and they talked about 17 times that the market's been down more than 15%. It's 11 out of those times it bottomed when the Fed pivoted to dovish or pivoted to neutral. Do you think so? Because I'm on the same page with you of one more deep spike. So my question to you is, what's the time frame we're talking about? If by mid-fall the Fed starts to pivot and starts to talk dovish again, could that save the stocks? And when you're talking about this 8 sigma events, does that bring us to down 35%? Is that what you're saying? Is that what I'm hearing?
Possibly. So the question might be, what's going to have to happen for the Fed to go, whoa, got to pump the brakes? And again, I'm not really sure what that is. Is it going to be, listen, we know that jobless claims in the employment situation is always lagging. We just had Silicon Valley come out and say, all right, we've let 10% of the workforce go. Of course, a lot of them are very highly employable with a tremendous amount of subject matter expertise. But assuming Joe Normal that answers the phone or makes sure that you get to the right elevator space that you need to go to, all those guys are going to be trimmed down. Also, that's not hit the employment number. And so next month, with everything continuing to contract, we should see a number that goes, oh, that might be a little troubling. And if that's the space, I've heard lot of people go, you know what, the Fed's not going to care about that. Their mandate is inflation, inflation, inflation. Now, another reason I think the market ticked up today is because a lot of people believe that the CPI top ticked with this 9.1. And so maybe, maybe not. We know it hasn't top ticked in Europe because Putin shut the gas off. And the entire economic driver of Europe is Germany, and they're already paying 55% more than they did only 2 months ago for that sort of thing. So what is it that's going to have to happen for the Fed to go, okay, we've done it? And that the only answer to that question that the Fed seems to be telling us they're looking for is, hey, CPI needs to top tick, and we need to see that we're doing something. So obviously we know, because we're out running businesses, we know that things are coming down, and we're just waiting for the numbers to show, and then for them to go, okay, exactly what do we want to look at with these numbers? And that main driver again is housing, because of all the industrial products that go into the housing space. I mean, didn't we just see 2 big mortgage companies shutter this week? I think I just saw that. I wish I could remember the details. And then we know they've laid off tons and tons of people in the mortgage space. And so that in itself, I talked to Denise Schull. She said today, 9 houses for sale in Sun Valley. Last year at this time, none. And so that doesn't stop the fact that there are less houses on the market for sale than need to be. So we know there's a little bit of cushion there. But again, this is sort of a rolling snowball that just is gathering things. And really, if the Fed is being single-minded and saying, hey, we're just looking for that number to top tick and start pulling back, if it top ticks, let's say they raise 75 basis points, and next month we can see a dip in the top tick. Now that's really going to affect what they do in September, I think.
Okay, so this can be a one-word answer for you, and then I'm going to let Bobby get in a question too, because I tend to hog all the spaces. You probably know that about me anyway, though. But if all that you just said is well and good, but if the stocks are all of a sudden down 35%, does the Fed flinch? It's a yes. It's about to come out of that mouth. I can see. Yes, they do. Right, Bobby, do you have a question?
Well, I have a comment. First of all, I think not that this isn't going to happen, but if stocks are down 35% and they flinch, there's no credibility, because we've already been down almost 30. Like, we've literally almost been down almost 30, and they still just keep firing out the rhetoric about we have to get inflation under control. If you think of the Fed's 2 mandates, and this is to you, Anne-Marie, if you think of the Fed's 2 mandates, it's employment or full employment and inflation.
Yes.
They are currently under the regime of theoretical high employment, maybe not full, but
Right.
it's close to full at 3.6%. So it's my feeling they have a very small window to continue to be aggressive and say, well, we have these 2 mandates, and one of them is close and the other one is really, really far, right? So I want to get Anne-Marie's opinion. Jimmy, please chime in as well, as always, which I don't think I could stop you from doing it. If my ideal scenario is earnings crushes stocks this earnings season, takes it down 30, 32, 35. And I've been saying this all week to anybody that would listen on my TV spots and my webinars, whatever. That would be ideal for me. Because if we can get through this earnings season, I think the psychology will then be, okay, bad earnings season. This is our base on how bad it's going to get for corporate balance sheets. And now inflation is coming down. You know, we talk about inflation peaking and coming down. I've talked about this a lot this week as well. CPI is an index, right? And the index was at about 296 and change on this past reading when we saw it 9.1% higher year over year. if we get a 0, it's still 296. You know, it's still 15.7% higher than it was in May of 2020. And I did a little work on that too. Not much because I'm not that deep. But from May of 2020 to this past number, inflation, the index, climbed from its post-pandemic low to where we just saw 15.77%. In the previous 4 years, Feb 16 to Feb 20, 9.1. So you're talking about if you just average that out amongst those months, 25 months versus 48 months, it's 18 basis points a month versus 63 basis points a month. I know I'm getting to a question, Anne-Marie, I promise. So inflation, the CPI curve always goes up, just like stocks do, right? They always go up eventually, but it went like this, right? So even if it dips, doesn't this still hurt? I guess that's my question.
Oh, absolutely. The question is, though, yes, it hurts. It's all going to have to hurt. I mean, we just have got to come to the realization that if we haven't already been hurt, there's hurt coming. How do we? So it's my suspicion that the speed of money is what really causes inflation. And so a lot of people argue about da 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 da. But I sit on the side of, hey, listen, the faster money gets into a system and the more money there is to divide among products, the higher prices will go, right? It's just the standard supply demand bidding war. And that stimulus that we had really is if there were a way to really take that number, that CPI number that you just deconstructed, and move it and pull out the pieces that had money flow associated with them to see what would happen. Because listen, we've been in this low quantitative easing space for so long, and everybody was calling, every single person was calling for massive inflation. And the only thing that changed was the incredible speedy flow of cash to everybody, not even those that really needed it and those that didn't need it at all. Everybody was getting cash. And so I think that to even blame Powell, which I know I'm probably not going to come off in the right space here.
Not to me and Jimmy.
But if you don't blame him, you're in the wrong space.
Well, see, here's my thing. I think there's a lot of blame to go around because he's been dealt something. And now, because I believe inflation, listen, they're always behind the curve. They're always moving too slowly. They're always moving. Oh yeah, we should have done that a year ago. That's just because of what they use to mechanize their motions. They're always behind. But it's a fiscal event as well as a policy event that created this massive spike. And so we're not looking at fiscal things to go, hey, how can we fix it? We're just looking at we're not looking at, again, a fiscal from a political standpoint. How are we going to help this? We're just looking to the Fed going, hey, you're going to have to fix it. And so although he's part and parcel of that big problem, I can't put the whole apple in his lap simply because of how I believe inflation's created.
Okay, so 15 months ago, when he was buying $40 billion of mortgage-backed bonds into the headwind of a absolutely red-hot
100%.
Okay, good. So any one of us who, and gosh, far be it from us to be those academics, those ivory tower academics, every one of us, our first day at the Fed would have said, hey guys, stop that right now.
Pump the brakes.
That's stupid. Okay, good. Bobby, you're with us on that too, right?
Yeah, I'm with you guys on that. I guess just to
okay.
wrap up, Jimmy, so then you can comment on it as well. I guess what I'm asking both of you is, I'm starting to fall into the camp of a minor recession that might last a little longer than we think. Like you look at something, I talked about this just a little while ago, Jimmy, when we were on Scott's show together. Healthcare is up like over 15%.
Yeah.
Health insurance, I'm sorry, health insurance. And
Yeah.
that's not something that's going away.
Right.
If any industry doesn't give back a price hike, it's the health insurance industry. They just don't give it back.
Yeah.
So I guess to Jimmy and then to Anne-Marie as well, do real earnings have to turn positive before the economy recovers? And by the way, if we have a weak earnings season, I got a list. My list is over here somewhere of stocks I'm going to buy, right? Buy and hold. So I want to be bullish as all get out. I just need that one more down move, Jimmy.
So when you said earnings, you were talking about corporate earnings. You weren't talking about wages at all, correct?
Correct.
Yeah.
So yeah, I'm going to defer to Anne-Marie on that question because I don't have an answer to that.
I think I'm looking at all the analyst ratings, and they really haven't. I don't think they've brought their estimates in enough to actually show what's going to come, because I do believe we're going to have a bad earnings season, simply because, and I'm going to say bad earnings season as a whole, there are always some great winners out there, and we definitely want to watch them, particularly in that healthcare insurance space. It's the only thing that's literally been green almost every single month this year. It's the only space. And so I believe that shock that comes from, oh, they missed earnings, it's going to pivot all the analysts that eat their hamburgers and whatever else at lunchtime together, because they do talk a lot with each other. They're going to go, you know what, we're wrong here. We need to pull back a little bit. We need to whatever. Didn't Goldman pull in? And I think Morgan Stanley also pulled in how much they felt like corporate America would earn over the season. All of these things are people starting to whisper, hey, this is going to come down. I just don't think they brought them in enough. So we're going to see a little bit of shock in terms of physical, hey, I can't get my hands on X, Y, or Z because of either supply chain, or I don't really have enough orders in the pipeline to say, hey, I'm going to, guide higher. I think guidance is going to come in quite a bit lower as we see it. And I think there's going to be a surprise there.
Okay, so I have we had Brian Westbury on the show a couple of weeks ago. And this is going to pivot from earnings a little bit. I hope that's okay.
Sure.
And he talked about the simplicity. He's a monetarist. And he's saying, and I'm going to wind this in, it's not going to be nearly as long as Bobby's question, which I took 2 naps during Bobby's question, I think. Sorry. But anyway, he said, if you have 10 apples and $10, and that's all that exists, each apple worth $1. All of a sudden you throw 40% increase in money, you have $14. Each apple goes up, it's worth $1.40. That's the base of the equation. Now what I'm getting at here is the real estate market. So we saw real estate go through the roof. I have one house in Colorado. You guys have houses in Florida. I mean, it's unbelievable what has happened. Now all of a sudden the worm has turned, and it's very clear in the real estate market. My contention is that people who have been around as long as we have, the tendency is to start to think 2008, but no, that was about excess buildup in positions. There still exists the equation that the value of a home is different based on the fact that we've increased the money supply by 40%. Is there any validity into that theory, or do you think that we could see a 25% decrease in real estate prices?
I think that a real estate decrease in price is absolutely coming. I would argue about the 10 apples and the $10 and the influx of money affecting the price of apples from that very standard space. That's simple, but all apples don't sit in the same place, and everybody didn't get the same amount of money. And so what ends up happening is these little levers that pull in different places. And so say Louisiana might see that 25%, but those of us in Southwest Florida sitting on the Gulf side, we might see 5%. Those of us that are sitting in the lovely burbs of the Chicago area might only see 7 or 10%. And so, yeah, it's definitely coming in because it's been too hot. And really, if you compared a 30-year mortgage and you said, hey, if I want my house payment to be, I don't know, $2,000 a month, before mortgage rates went to 5.5 and they were sitting at around 3, you could have a $500,000 home. Now you're looking at a $350,000 home, and that's only been 6 weeks. So it's much more of an affordability stance. And although there are still more people, there used to be 10 people for every one house. Now there are 4 people for every one house. They might not be bidding it up 20, 30, 40, 50% and saying, hey, you know, I'll do anything that it takes to get into this house. So that shift is going to come.
And to put a finer point on that too, my wife is a real estate attorney too, and we just had a discussion about this last night at dinner, is that even in our—
I love the way you talk about her. I love the way you talk about her.
She's great,
the best. Yeah. I love the way you talk about her.
That's a joke because all my friends know that if Margaret left me, I'd have a fabulous 2 weeks and then be dead. She's the only thing that keeps me alive. And it's a joke that I call her wife number one because everyone knows
I know. I tell my husband that all the time. So it's so
some
funny.
people will corner me and be like, you shouldn't speak that way about your wife. I'm like, dude, come on. It is absolutely a joke. She gets it. She laughs. Yeah, she shakes her head.
I love it. It's hilarious.
But anyway, even what we're seeing in our little enclave in the northwest suburbs is that premium houses are still selling relatively quickly. Places in not good location or not. Places that are well kept, before everything was selling really quickly. And I think you can broaden that out forever. That's why I was confident in keeping the Colorado home, because that's a premium location. We are trying to sell a property in Downers Grove right now, which is less of a premium property. And I have this feeling that I missed the boat by that in a couple of months. You mentioned healthcare as being one of the sectors you like in this. And I get the general sense that you think the stock market is a piece of shit. We can say that it's Friday afternoon. Is there any bright spots in sectors you look at besides healthcare?
I think there are going to be some biotech stars that come out. Looking at some of them that I'm trying to look for the ones that have done well with cancer treatments, Alzheimer's. As we age demographically, more money is going to get fueled into that, right? Everybody wants to live longer and live healthier, but we simply aren't doing that. And the reason we're not doing that is because we eat like crap, first of all. And then we have pharma that goes, no, I got a pill for that. And so outside of that, we're still going to have a lot of money that's going to get put into that space. So although if you look at dispersion just in the biotech space and you go, okay, show me what that whole group looks like in terms of return, it has the widest dispersion rate of any of the sectors. And by that, I mean, there are way few of them that are up 20, 25%, way few of them down 20, 25%. And everybody in the middle is sort of scattered around. They're not clustered like we might see in the energy space or in financials, where everybody's like 2 or 3 or 4% over the year. And so it means you got to do a lot more research in there.
Bobby, do you want to close out with a couple questions for Emery before we get to the trading part? And Ann, Emery, are you going to stay with us for the trading
absolutely.
part? Good.
Absolutely.
Bobby, what do you got?
I don't know how much time we got.
I would say about 3 more minutes of this, then we move on to the trades, right?
I don't think I could get a question in 3 minutes. I think
neither do I.
I just actually want to throw a comment in there. By the way, this is my second wife, but I call her the PDF, the final. There's no more editing. It's interesting to look at This is one of the things I've always liked about your work, Anne-Marie, because like a lot of us are just kind of like trading floor slags, and we're just like, yeah, I'll buy this. It looks good. Chart looks good. And we've gotten more sophisticated over the years since we've left the floor. But the healthcare, like the spider sector ETF, healthcare was up 25.8%, while the S&P was up 28.4%. But on the downside, S&P down 19, with the healthcare sector down 7. And I always tell people all the time that the name hedge fund has gotten bastardized, basically. A hedge fund is supposed to perform fairly well when the market's doing well and then hedge you on the way down. And it's one of the things that drives me crazy about a place like CNBC. Jimmy and I can now both talk honestly about it, is that they would say, oh, you're underperforming your benchmark. Well, the S&P is 28, I'm 26. Well, you're a hedge fund, they're paying fees. Well, paying fees for now, not for then.
Yeah.
Like then anybody can make money. It's now. So I appreciate that. No, I'm ready. I got my question answered. So I'm ready to do trades, and I'm ready to hear. We have opposing views this week, and
good. That's fine.
I don't like your trade because I like mine.
Okay, good. That's fine with me. I like having opposing views. But I'm going to say one thing about the trades we talked about last week, and I think it's important to underscore a couple things. My trade was to buy the NASDAQ if it traded above 12,270. It flirted with it, but it never did. My trade was to buy the 10-year micro yield contract if it traded 312. It came within a half tick of that the next day on Monday, but didn't. So neither trade activated. And again, people who are outside the trading world, they sometimes think it's exciting, and it's mostly just watching screens and waiting for things to happen. And it can be absolutely boring as hell. Neither of those trades worked because they didn't get put on. So I guess they both worked because I didn't have to lose any money on them.
Well, I look at it this way, and Anne-Marie, you can comment on this if you want. There's 3 outcomes of a trade. There's a win, a loss, and a break even. 2 of them are good. And I consider a trade that wasn't triggered to be break even. So my crude oil trade from last week, I wanted to sell a rally back to 107 and cover it at basically 93. We got to 93, but we never got to 107. So I never got that trade on. I think we were just above 105. And I'll tell you what, the hardest thing, and Anne-Marie's mentored thousands of traders. You can comment on this before we go into the trade. The hardest thing I've found over my 30 years was when it's coming up to my level and then I see it start to turn, is to move mine down. The hardest thing still to handle is a trade that works and that you followed your process, but you didn't get into because it didn't get to your price. That's the hardest thing to deal with. I've always maintained traders hate missed wins more than they hate losses.
Totally agree.
Jimmy, let's do your 10-year trade.
Okay, so this, I guess, is a recession trade. It's a curve steepening trade. It's more of a technical trade than anything else. As Bobby and I talk about on this show all the time, both of us follow price more than fundamentals. To me, I describe myself as 65 to 70% technical, the rest fundamental analysis. And when I use the fundamental analysis, it's just to try to talk myself out of the technicals. And this one, Bobby's going to probably try to do this to me in the 10-year. But this is another one of those stop-in trades. And this is the July 10-year micro CME contract. We're trading July in that now, right? Yeah, we are. Yeah. So if it trades 2.88, which is a couple ticks below where it is now. Again, this is one of those stop-in trades we talk about, which is counterintuitive to some people because I want to sell it, but I want to sell it below where it is right now. If it trades 2.88, I want to be short and take it down to a target of 2.55. Then conversely, if I get in and then it trades back above 3.13, and we know that that's a level of importance because it flirted with it like 3 different times last week, and that was essentially where my stop-in was, 312. And that'll be my stop out. If this trade gets to its target, it makes $330. It's $10 for 100 for the micro, and it loses 250 if you're stopped at a level. Bob, you want to tell me how much of an idiot I am first or no?
No, I like this one.
This is the one you like. Oh,
this is the one I like. It's the other one I don't like. This one I actually like because I think, even though we saw the yield curve invert, I think it's going to continue to invert. The moves were bigger in the 10-year and the 30-year than they were in the 2. The 2 was actually up 2 basis points this week, while the 10 and the 30 were down. And the 3-month is through the roof. It's up over 42 or 3 basis points since the middle of June. which you never see. So I think overall yields are going to start to rise as the data keeps coming in, as more and more people believe the Fed's going to be doing 75 and might have to calm down as assets fall. So I actually like this trade. I don't know if I'd call it a recession trade. I think I call it more a short-term, very smart trade.
Okay,
What's
cool.
the
Anne-Marie,
expiry
thoughts?
on that? What's the expiry on that?
They have the contracts, the micro futures contracts at the CME are just monthly. They expire near the end of the month, but then you just roll them into the next one.
Okay,
So
so
we
you can
keep
roll
our
it.
G rating
Okay.
if I eat this, do we?
What's that?
We keep
I
our
think
G
so.
rating if I eat the cherry out of my drink.
Absolutely.
No, yeah, no doubt about it. Can you tie the stem into a knot?
No, I can't.
I can, but sadly, no one's been impressed by that ever. But anyway, so Anne-Marie, back, you were answering before we rudely interrupted you.
Okay, so that's just a rolling. So that's that's very interesting. Again, I don't trade interest rates like that, and so I did look at that, so I'm going to be watching it. I'm
Okay, good.
definitely going to be watching it. Yeah.
Good. We we're both futures
Yeah.
guys from way back, so we we both lean towards futures more than anything else. It was only about 20 years ago I realized there was like active traders in other spaces besides futures. I didn't know that people like actively traded stocks.
I love the future space. I just don't. I haven't stepped into the futures that run the interest rates. I've just never traded them. I sit with the ES, the NQ, the RTY, oil, gold,
sure.
The euro.
So I just had
I haven't touched that.
I just had a great idea for another show, Anne-Marie, if you want to do it. We taught the first time I actually physically saw you was in 2018 in Las Vegas at one of those things, and I was giving a speech, and I gave a speech on futures, and one of the guys came up to me and said, "I don't understand the S&P futures. When they move, which way do they go? Like if the S&P goes up, which way do the futures go?" And I was like, wow, I got work to do.
Yes.
I got work to do. So we can do a show with you and Jimmy, or you and me, or all
Love
three
it.
of us. Basically, contrast and compare cash to futures all the time.
Yep, that would be
Bobby,
great.
what's your trade?
So I want to go short the S&P on a rally. Now, let me tell you what I don't like about this trade first. Okay, what I don't like about this trade first is we're in a bear market, and bear market rallies are just, they kill you. They crush you. So I got a very tight stop on this because I expect slippage if I'm wrong. Okay, I think it's going to probably blow through me if I'm wrong, but there's a little horizontal channel that starts about June 22nd and goes over the last few days. And the top of that channel is right around 3,900, a little bit higher than that, but I decided to pull it back a little because I wanted to get in. So I want to sell a micro. These are the micro S&Ps. Again, if I get the slippage, I'm not going to get crushed. The risk is $295.25 per contract I put on. My stop price is $39.59 and my target price $37.85, which will give me $573.25 per contract if I make it. So it's almost 2-to-1. You got plenty of room for the slippage on one of those rip your face off bull markets. Anne-Marie, you want to give your opinion on that before Jimmy gives you his long S&P trade?
So I actually like that element of that trade. My thought would be, what do you think about if you enter into a position like that, what do you think about letting it blow past your level and then catching it on the way down, so that when it starts rotating over, you actually see where the real risk is sitting? Or at least that's what I would do. That's how I like to look at a line.
I love that you just did this. So we call that in our little Path Trading Partners trading room, we call that a shake and bake. So in other words, it breaks out of the channel and then breaks back into it. And we do short those. We do short those. And that's honestly, I said when I was giving the levels of the trade, I go, that's probably a little bit higher, because I actually prefer catching a move that's already happening than trying to pick one.
Exactly.
This kind of format, right? It's difficult to explain that. Like, it's difficult to give a trade out and say, okay, here's what's got to happen. It's got to go through here. It's got to come back down. It's got to test. It's got to close back below. It's just difficult. And Jimmy already complains about how much I talk. So
No, but people, if you're watching this show, we should put that out 44 minutes and 30 seconds into it. That's the value takeaway, because what she just said, I trade that way all the time. And like look at the level and like wait for it to fail, then boom, that's to represent. And I really think that was brilliant. Okay, Bobby, now I'm going to tell you why my trade is essentially the opposite of Bobby's. And here's my reasoning for it. Now, here's my reasoning for it. Today, the stocks were buoyant as hell with reasons not to be buoyant, right? I mean, like we said before, the door was kicked open for the Fed to be more aggressive, not less. What realistically has been happening all year is that the stocks have had to get used to higher interest rates. In the short term, interest rates are going up. There's no way around that. And yet the stocks had a bit of a relief rally today. One thing we've been missing throughout this whole episode, we talked about the fact that the VIX never spiked, but also we've never had the real melt your face rally that leaves people all in the dust and makes people think that the bear market's over. That's been absent. I'm not saying it's going to happen. I am saying I'm encouraged by the buoyancy today. So here's my trade. It's 38.75, which is, again, I haven't looked at the market since we've been talking, and I don't know if it's closed yet. It's a stop in at that level. I have my stop set already. I also have some options that'll be gaining delta above that level as well. So stop in at 38.75 and target 40.20 on the upside, and a stop back below 37.80 if it comes back down. So that trade would make $725 if you hit the target, lose $475 if you get stopped out at your level. Anne-Marie, you shook your head when I was saying about the buoyancy today. Is that something that's important to you before I let Bobby eviscerate it?
It's all about that notion where we go, gosh, we had terrible news early in the week, and it's like everybody's digested it and we're moving on. So it really doesn't matter with bad news. We're still buying the dip. And we haven't seen that melt your face rally. And it might be coming. So
it likely is, right?
There's a validity to that, right? Especially since really there are a few things that are basing that haven't been basing in times past. We're seeing a few things. So it's definitely a possibility. Again, right where he's positioning that short is where I think we're going to bump into those first sets of problems, like 39.10, 39.12. And then if we have a short squeeze, you could get up to, your 39.50-ish area, but it's going to take a big rally of real strength. And I'm not seeing delta flow that would signify that yet. But that's how those bear rallies work. They just come out of the blue and rip your face right off.
I think it's time. And if we do get a big, good bear rally, I am going to, in the long term, my investment accounts, I'm definitely going to restructure things. And I have, and I've been fine this whole time. And again, I'm not trying to pat myself on the back, but it seemed pretty evident early January that if rates are going up, stocks are not going to fare well. This is not something that's been a surprise to anyone. I wish I repositioned even better for that, but I didn't. We're coming towards the close. If you ever do come to Branson Palatine, what's your drink? What's your go-to drink?
Sparkling water.
Oh, you don't drink at all?
I don't. I have serious control issues.
That should have been the first question. We might not have even done the podcast.
Right. No, hey, I got plenty of friends who don't touch the stuff, and all of them have different reasons. Right. And all of them have different reasons, but a lot of them are remarkably similar. A lot of the Southside Irish crew that we worked on the trading floor, they drank their fill and then they decided against it going forward. And we have nothing but respect for them. But if you did come to Branch, you'd have a burger or you'd have the ribs. Don't tell me you don't eat burgers or ribs either.
Is there a combo plate for folks?
We call it the out-of-towner special. It's a burger and a half slab of ribs.
I'm in. Yeah.
My cousin, who's about 6'5", comes in from Colorado, and he would order. He finally convinced us. He's like, I want. He eats a ton. He's like, I want a burger and a half slab of ribs, and now we have it. Call it the out-of-towner special. It's brilliant.
I'm buying puts on you having a blood relative that's 6'5".
I do. I swear to God, I do have one blood relative who's 6'5". I don't know what happened.
I'll buy all the puts you're selling.
Okay, maybe there's something different about it. All right.
I want the DNA though. I'm just saying, I want the DNA test.
Right. Okay. So Amory, trader, chief market strategist at tradingbook.com. Tell them where they can find you on Twitter. And if, by the way, if you guys don't follow her on Twitter, you're stupid because she puts out a lot of great stuff. By the way, should have mentioned this earlier today. There was something you tweeted that said, probably time to take some profits here. And I looked at my chart and I was like, oh, she's actually right. And I did. So you made me money today, but where can they find you?
Thank you. You can find me on Twitter at Anne-Marie Trades. You can find me on StockTwits. You can find me in the Odds Investors Business Daily Chat or Benzinga Pro. And very once in a while, I will come on just before Bobby on TD Ameritrade.
Fantastic.
You can also find her in Rosemont tonight if you're over there.
Yes, that's right.
Luckily, this won't come out till Monday, so you don't have to worry about it.
When you guys do TD, do you ever get interviewed by Jenny Horn?
Once I did.
Yeah.
Well, because she's kind of a mutual family friend. Like I'm going to be at a wedding with her, and I think she's such a fun kid, and I hope she does really, really well. I like her quite a bit. Yeah. Cool. Okay, that's it. Then we just hang up, Emery. There's no closing bell ceremony. Nobody
Thanks so much,
bottle of
guys.
champagne and anything. Thank you for being here. This was a lot of fun.
I appreciate it. I'll look forward to seeing you on the street somewhere.
Good.
Oh,
come out to Brant's.
What do you live
you're
in?
talking to Bobby.
Yeah. No.
He's literally about to hang up. He's like, I don't care. So I actually live sort of in your direction. Like if we were to meet in the middle, I'd be closer to you. I'm in sort of northeast Naples.
Oh, all right.
So about 15 minutes from the water. You know, somebody said to me, you moved to Naples, you moved 15 minutes from the water. That's too far. I said, you're an idiot. I used to be a 2.5-hour flight from the water.
Yeah, there you go.
Now I just get in my car, hop on my motorcycle. I'm there in a blink. So shut up in your snow. Anyway.
Okay, you hang up. No, you hang up. No, okay, see ya.
Thanks, guys. See you soon. Bye-bye.
I'm staying. Bye, Emery. Take care. Thank you very much.
Bye-bye.